you really can't ask an analyst like me to make Sophie's choice as to what's their favorite model. So I'll say this is one of my favorites is definitely the Market Pulse. One of the ones that I'm most proud of is definitely the Market Pulse, because I think one of the biggest challenges in markets, frankly, is defining sentiment, defining behavior, and really understanding behavior, because you can cherry pick indicators all day long to tell a story, right? But this gives you a very quantifiable, historically back-tested and proven mechanism for at least trying to define behavior. The other thing I'll say, and you didn't ask me this, but the thing that I think is important for at least me to keep in mind is never to be complacent. And just because this model has worked, at some point in the future, it won't work. And so we constantly have to retest indicators and constantly have to pay attention to what the model's doing.
What if the global markets were telling a single hidden narrative? In today's interconnected economy, a global framework is essential for navigating the markets. While headlines differ in Tokyo, London, and New York, the data tells a unified story through one language: technical analysis, the visual blueprint of global market psychology. Understand its patterns, and you can read the story before it becomes a headline. I'm Flávio Lemos. On Traders of the World, we decode this fascinating language. Join us to see the world's next move. Hello, traders, and welcome back to Traders of the World. Grab your headphones, tune in, and let's decode it together. But before we unlock today's market secrets, our guests generously share their valuable time and experience. If you appreciate their insights today, hitting the like button, subscribing, and commenting with what you learned is a wonderful way to show that gratitude and helps ensure these important conversations with fellow traders and investors. Your engagement makes a real difference. For such a special occasion, I'm not alone. I'm thrilled to be joined by Raphael Figueredo. Raphael Figueredo as a co-host. He is better known as Rafi. He's an equity strategist at XP.Inc. XP. With 20 years of professional experience, he has built his career as a strategist and market analyst. Hello, Raphael. How are you doing today?
Hello, Flávio. Nice to be back here, and nice to have, of course, our special guest here, Gina.
We are just days away from Christmas, and we know Santa Claus is busy up north checking his list twice to see who has been naughty and or nice. But honestly, I think our guest today might have him beat. Like Santa, she oversees a massive operation, but instead of elves, she managed the strategy platform at Bloomberg. Like Santa, she knows exactly when the market is sleeping and when it's awake. So today we are joined by a true triple threat of financial world. You know how some people are good at math, some are good at charts, and some are good at economics. Well, our guest decided to be good in all of them. She has more letters after her name than a Scrabble board, CFA, CMT, you name it. She spent years at the global head of portfolio strategy at Bloomberg Intelligence, building the very tools and models that many of you stare at your own terminals all day. Now, she is the chief market strategist at HB Wealth. And while Santa might leave you a lump of coal if you are bad, Gina Martin Adams will just hit you with an underweight rating and a 30-page report on why your valuation is 4 turns too rich. She's here to deliver the ultimate gift to our portfolio, clarity. She's here to explain why the Magnificent Seven might be masking a market problem, why her models say that the S&P is 4 turns too rich, and what on earth the HERFINDAHL-HIRSCHMAN INDEX is.
Thank you so much, Flavio. Good to see you, and Rafi as well. I'm so delighted to be here. I feel like I should leave now after that introduction. It can't get much better than that, so thank you. I'll try to live up to these expectations, but you've really pushed them high.
You ever wondered what truly connects traders from Tokyo to London to New York? You just need to learn the language. That language is technical analysis. Understand its signals, and you'll understand the world. Welcome to Traders of the World. Here we skip the jargon and just figure it out together.
Okay, Rafi, please.
All right. Okay, let's kick off, Gina. So let's start with your background a little bit. So you are, as Flavio said, a bunch of layers like CFA and CMT. And so in this industry, people usually pick a side, like the fundamentalists or technicians. And as we know, you chose both sides. So was that a strategic decision to dominate the world, or did you just really like taking difficult exams, or how do you blend those two brains into your daily process?
Yeah, it's a good question, and the honest truth is I needed more. I needed more understanding. So wasn't a quest to dominate the world so much as it was to explain what was going on in markets for me. I was working on the buy side right out of university as a portfolio analyst. And I was started in the CFA program because that's what everyone did. Really quickly understood how useful and the program was at applying to my day-to-day job and analyzing the markets and creating investment strategy commentary. So rode that for a while, and then hit all of the bizarre price action that happened in the pre-Great Financial Crisis years. So if you remember those years, oil prices were skyrocketing. The 10-year Treasury bond was in a famous Greenspan Conundrum. No one could explain what was happening in financial markets with traditional econometric modeling or even some of our traditional financial modeling, fundamental modeling. And so I sought out the CMT at that point because I wanted to understand the behavior of markets. I wanted to understand how to analyze price to really complement some of my more econometric and fundamental training. At that time, I was an economist, and part of my job was supposedly I needed to tell people where the 10-year Treasury bond was going to go. And at that point in time, even the chairman of the Fed was saying the 10-year Treasury bond is behaving abnormally. So it was a tough time to be a fundamentalist or a traditional economist. And so that's why I went after the CMT. And as a result of that experience, I find that without one or the other, I'm missing something. In most situations, I like to practice a blend approach. I've, in the period since then, really adapted more quantitative analysis skills as well, and do have a heavy respect for just constantly trying to improve, constantly trying to blend more and more relevant indicators, whether they be financial, technical, quantitative, into the toolkit in order to provide the best possible strategy going forward.
You were the global head of portfolio strategy at Bloomberg Intelligence. You developed incredible tools there, like the market pulse. Can you take us behind the scenes? What was the philosophy behind building those tools for the most demanding institutional investor in the world, and which tool are you most proud of creating?
Sure. So the behind the scenes, Bloomberg is a very innovative company. That's what Bloomberg does. They build products for analyzing the equity markets. I was in the research division inside Bloomberg called Bloomberg Intelligence. At the time that I joined, we were, compiling data, providing aggregated information, unique custom data series, as well as providing market intelligence through research. And it was just a natural progression, I think, to complement the data, the custom data series, also the research with the tools that we utilize to build the research. So we endeavored to try to effectively just bring all of our research to life through the tools. So really what we did is just showed the universe how we were analyzing markets, made the tools that we use to analyze markets available to the customers of the Bloomberg terminal. The Market Pulse was one of those tools, and the Market Pulse was developed really as my sentiment measure. We mentioned early on that something that I endeavor to do is understand human behavior's impact on markets, understand sentiment and what it means for creating major changes in the markets. Usually, as you know, as Warren Buffett has educated us all to be fearful when everybody's greedy and greedy when everybody's fearful, that's a sentiment measure. So I want to know when everybody's greedy and when everybody's fearful. And that's what the Market Pulse effectively does for me. This is a summation, if you will, of a number of years of trying to understand market sentiment and trying to define market sentiment. And I think everybody does it differently. A lot of analysts will look at flows, or they'll even survey, right? There's a number of surveys of professional as well as retail investors out there that folks will use to define sentiment. But what I wanted to do was define sentiment using the market itself. So we endeavored to go back and test what measures actually can we find inside the equity market itself to define periods of excessive fear and excessive greed and every stage in between. And as a result, we went through hundreds of different indicators over a long period of time, ultimately settled on a handful of indicators. They range from volatility to pairwise correlations to the performance of high leverage and low leverage stocks to the performance of cyclicals relative to defensive shares. Also, breadth is one of the measures that's in the Market Pulse Index. And that sum of the total gives us a sense of when all of those cues are signaling that the market is overly greedy, we know that sentiment is far too greedy, far too optimistic. And when that sum of the total suggests that the market is overly fearful, we know that we're at or near a major bottom in stocks that's forming. And it was just built on history. So all of these measures together have historically proven to behave a certain way at tops and bottoms. And so we look for that similar behavior at tops and bottoms using the sum of these indicators, and that's what the Market Pulse is. It's one of the things that I'm most proud of. To answer your other question, you really can't ask an analyst like me to make Sophie's choice as to what's their favorite model. So I'll say this is one of my favorites, is definitely the Market Pulse. One of the ones that I'm most proud of is definitely the Market Pulse, because I think one of the biggest challenges in markets, frankly, is defining sentiment, defining behavior, and really understanding behavior, because you can cherry pick indicators all day long to tell a story, right? But this gives you a very quantifiable, historically back-tested and proven mechanism for at least trying to define behavior. The other thing I'll say, and you didn't ask me this, but the thing that I think is important for at least me to keep in mind is never to be complacent. And just because this model has worked, at some point in the future, it won't work. And so we constantly have to retest indicators and constantly have to pay attention to what the model's doing, especially major misses in the model. I view as big opportunities to go back and reassess. Where did it go wrong? Is there an indicator that's now failing and is no longer useful for predicting or interpreting human behavior in markets? And that's something that I also try to do with all of my models, is constantly reassess, constantly, retap into those models to build them to make sure that they're doing the best that they can.
Market is dynamic, so
Yeah.
everything changes all the time.
Absolutely.
Yeah. Speaking of tools, Gina, one of your signature methodology is the MVP factor model.
Yes.
Yeah, it sounds like a sport awards.
Yeah.
But,
Yeah.
I know it stands for something else. So can you explain us the methodology behind it, and how do you weight momentum, value, profitability to find the leadership?
Yeah, so MVVP, it's actually MVVP, but we shortened it to MVP because, like you said, it sounds a lot more sporty. It's a little bit more attractive. It'll rings off the tongue a little bit better than MVVP. That's harder. But the MVVP stands for momentum, value, volatility, and profitability. And very simply, what we've done is we've taken any index. It now, I believe, still runs on the large cap index as well as small caps, and we built it for Europe and China as well when I was still at Bloomberg. But the large cap index, as an example, takes the Russell 1000, sector neutralizes and factor sorts all of the Russell 1000 stocks, and then every quarter, or the S&P 500 or the Bloomberg 500, you take it. Every quarter, it invests in just the top decile of those stocks on a long-only basis. It's actually a subset of quant factors that were built inside my team by Christopher Kane, also a technician, but he's a technician and a quantitative analyst as well. And he built a factor system inside our team that was a long-short factor system using all kinds of different factors. But we hand-selected momentum, volatility, value, and profitability for a long-only specific portfolio because we can prove that it works. We can prove that by investing only in the highest momentum, highest profitability, lowest volatility, and highest value stocks in an index, and then rebalancing it quarterly, only investing in the top decile of all of those factors together, and rebalancing it quarterly actually performs best and outperforms over long periods of time. The best parts of the cycle for this type of strategy are when markets are weak. So really where you get the biggest boost from this kind of strategy is when you have these major dislocations. It tends to draw down substantially less than the market at large and gives you that shelter from that downside risk. It still participates in upside, but over the last 2 years in particular, years that were driven by almost exclusively momentum, it's going to miss a little bit some of the extraordinary gains, but you still get gains. You just get sheltered from the downside risks when those downside risks emerge. And over long periods of time, you outperform magnificently. In particular, this works really well in European equities, we found. It also works very well if you use a profitable small cap benchmark. You can't use it very well on the big small cap index, but you can use it in a profitable small cap landscape. So we were experimenting with kind of changing factors into a long only strategy. And then this is where we landed at the MVP.
You tracked something called the HERFINDAHL-HIRSCHMAN Index.
Yeah, that's a mouthful, to say the least.
Regarding sector membership.
Yeah.
Now that sounds like a serious medical condition, but
Yeah.
it's actually about market concentration.
Yeah.
With the Mag-7 being so dominant, what is this index screaming at us right now about market health?
Yeah. So I think it really speaks to all the fears that have been in the marketplace regarding concentration risk. The Hirschman-Hirschman-Hirschman, I can't even say it, and I use it. This index is really just a fancy mathematical measure of concentration. If you look back historically, it's been around for quite a while, but historically, the concentration problem was really an emerging market equity problem. If you think about where we were 5 years ago, emerging markets were incredibly concentrated in Chinese securities in particular, right? And then you go through this period of time and all these, China experienced a tremendous amount of weakness in its equity markets surrounding the pandemic years. China had an extra year of shutdown after most of the developed markets were already reopening. It created a lot of losses in Chinese equities. So many people developed a strategy of investing in EM ex-China as the only other alternative, right? This is something that's happening in developed markets now, in particular in the US, with the evolution of the Mag-7. What we've found is the Hirschman-Hirschman Index or concentration risk inside the S&P 500 is higher than we see in our recent record books. You have to go all the way back to the 1970s to see a period of time. Remember the Nifty 50 of the 1970s? You have to go back to the 1970s to see a period of time in which concentration was so significant. And what it essentially means is we're just inordinately dependent upon this handful of stocks working in order for the index at large to work. That's been a great thing, honestly. The last 3 years is extremely anomalous in history. And I think we need to just recognize that in this concentrated market, we have actually had 3 consecutive years of greater than 15% gains, going on close to 20% gains. That's only occurred twice in the history of the US equity market since the 1920s. It occurred in the 1990s tech bubble, though, of course, then it was 5 years. And it occurred right around the pandemic years. It occurred in 19, 20, and 21. So it's an abnormal state for the equity market to be in. It is working for now. The risk is, does it continue to work into perpetuity? And I think this is what everybody is very worried about, is how can this resolve itself? Can we continue to see all of the market's gains so very dependent upon, in this instance, its biggest players? And those big players, of course, are very closely related to the AI theme. And the AI theme has just dominated markets. So, I think that this can resolve itself through a number of mechanisms. I think most people think, oh boy, here we are at a tech bubble state again. The natural evolution of this is that it's got to end badly. We've got to have a big crash. We have to see risk tolerance completely obliterated. And at some point, that's going to occur. Maybe. We don't know, right? Maybe that does occur as a result of this concentration risk. But I would say it's equally potentially likely that this could resolve itself differently. And it could resolve itself through broadening gains in the rest of the equity market, more risk tolerance emerging in the rest of the equity market. And I say that because the Hirschman-Herfindahl index of concentration risk was not an issue in the 90s. Concentration wasn't a problem in the tech bubble. The tech bubble was not about concentration risk. It was about everybody loves stocks and can't get enough of stocks and thinks they can gamble in the equity market, right? That was a very different condition. Remember, I said the Hirschman-Herfindahl index was less a problem, or was less so high, or markets were so concentrated in the 1970s. How did the 1970s resolve themselves? They resolved themselves in actually a longer-term bull market developing, because the concentration risks faded. We no longer had the Nifty 50. Now, there was a very volatile period in the 70s, so don't get me wrong, you can experience a lot of volatility, but I think you can have 2 different ways in which this could resolve itself. And we don't know which way it's going to go yet. We do know that markets have been performing extremely well. We should all be very grateful for this. But we also know that it's very unlikely that that degree of outperformance continues into the future. And I think the longer it goes on, the more and more likely it is that we will see slower long-term equity market gains as we resolve this concentration risk. It's just a matter of how it gets resolved that we just don't know yet.
There's a popular saying in Brazil that says that dogs that were bitten by snakes are afraid of sausages. So it's like this.
Yeah. That's great. I haven't seen one.
Raphael loves my coats. But when we interviewed Rafa Campora, he said that the fuel of the market is rotation. No?
Yeah.
He always said that the rotation. Yeah. So probably you're gonna see other sectors outperforming the technology. Yeah. But as we are speaking about this, you recently posted that this cycle isn't about large caps beating earnings. It's only about the Mag-7. You noted that the ex-Mag-7 stocks haven't beaten forecasts since 2021. So, Gina, please, can you pull up that chart showing the divergence between Mag-7 earnings beats versus the rest of the index? Is this sustainable, or is the rest of the market finally going to wake up, like Ralph said?
A Trader Brasil comemora 25 anos e quem ganha é você. Fomos eleitos por 2 vezes pela Rank Awards em 2024 e 2025 como o melhor divulgador financeiro e a melhor academia de formação de investidores do Brasil. E hoje temos um presente para os inscritos do canal. 10% de desconto em nossos cursos usando o QR Code que está na tela. E não se esqueça, é muito importante que você nos siga nas redes sociais. Curta, comente e compartilhe.
All right, so the chart you reference is this chart in our piece. This is another model that I run to analyze the equity markets, and this is more of a fundamentally based model. It gives you a fair value estimate for valuations for the S&P 500, and on this exhibit you see what the estimate is plotted against the market cap weighted and the equal weighted index. Later in this piece, we did a bit on the Mag-7, as you referenced, the Mag-7 versus the rest of the index. Now, this has been really, really interesting, and I don't think that a lot of folks understand just how not only price concentrated, but earnings concentrated this market has been. And it's having ripple effects all over the place. But this chart shows you Mag-7's actual earnings are the darker blue bar in comparison to their estimates. So you can see how much Mag-7 earnings beat expectations in 2023, 2024, and 2025, really consistently beat expectations. The ex-Mag-7 stocks have missed expectations for the last several years running. So all of this rhetoric that you hear constantly, that earnings are quote unquote strong, earnings have been quote unquote better than expected, that really applies to the Mag-7, not so much the rest of the index, where earnings are not strong. As a matter of fact, when you look at the aggregated numbers, earnings have been growing well below average for the last 3 years running. We're talking average annual growth of something like 3% for ex-Mag-7 earnings, whereas over the long term, this group produces double-digit average annual earnings growth. In contrast, the Mag-7 has beaten expectations and produced much faster earnings growth than is normal for that group subset of stocks. So this divergence, I think, explains a lot. And it explains a lot in terms of market psychology, where you have the concentration evolving. It's evolving not only because people like Mag-7 stocks, because they have a justified reason to like Mag-7 stocks. The concentration is also happening because of the lack of performance of the rest. And this, I think, is not that well understood, that because the rest of the index has not put up the earnings numbers that analysts had expected, they also have put up slower than average earnings growth. Capital is naturally not concentrating there. It's not naturally not going to reward underperformance. Capital is going to reward the outperformance, and Mag-7 has outperformed. So this is something I think we need to watch really carefully, because if Mag-7 keeps outperforming, then the concentration is going to continue. If the rest of the index suddenly starts to produce some growth, which we think we could see into 2026, we started to see this in early 2025, but then trade policy created a lot of distortions and a lot of uncertainty, and the Fed went on hold, remember? Now the Fed is easing again. Trade policy hopefully is normalizing. We see some boost from fiscal policy emerging into 2026. We could be in a situation where in 2026, ex-Mag-7 beats expectations for the first time since 2021. Or at the very least normalizes growth to something closer to double digits from what has been this really suppressed growth. At the same time, the risk is on the Mag-7 to hold up their end of the bargain. Will Mag-7 actually be able to put up the growth numbers that consensus is anticipating, considering how much weight they've carried for the S&P 500 for the last 3 years? I think this is a critical question for the year ahead.
Yeah, definitely. This is a trillion question because of,
Yeah.
we are dealing
Multi-trillion dollars question. Yeah.
All right. Gina, you mentioned in your regression model that suggests the S&P 500 is trading about 4 turns to reach based on current rates and earnings. That was this is a bold call, of course. And can you show us the valuation model chart? And if the rates aren't coming down to zero, does the price have to come down, or earnings have to skyrocket to close the gap?
Yep. This is a great question. It's something that we did address, so thank you for noticing. I'm showing the chart on the screen now. It's in that very same piece from last week on the HB Wealth website, but the chart shows you how fair value PE has traded over time. Now, the first thing I'm going to say is this is a macroeconomic model. Valuations are very difficult to forecast. They're also a terrible timing mechanism. So you have to have a lot of caveats anytime you talk about valuations. Nonetheless, what I think is most interesting from this model, the dark blue line is the estimate from a macroeconomic regression. And what we do with this regression is we say valuations over time have historically been driven really by 2 factors. One is interest rates, and the other is earnings growth and long-term earnings growth expectations. As those change, that tends to drive valuation multiples. And basically, we use long-term earnings growth as a proxy for sentiment. But nonetheless, what you get when you do a regression of those factors on the S&P 500 valuation is the dark blue line. And you can see that through the majority of history, our model has actually said stocks should be valued at higher levels because extremely low interest rates, especially in 2020 and 2021, really distorted the model. I mean, when you get to 0% interest rates with the greatest explosion in monetary policy support that we've ever seen as a share of GDP, you get distortions in the model. But nonetheless, as you could see, the model said that really since about 2016, we've been undervaluing stocks. It was constantly telling us interest rates are so very low and earnings growth is accelerating so much, and we should be paying more for U.S. equities than we have. Until last year. Or, I'm sorry, until this year. I'm already 2026 in my mind. I'm already there. So
no problem.
Until this year, this year's the first time, and really only just in the last few months of this year, did we get to a point where our model was saying, okay, hold on. We now have priced well more than what is substantiated by these macroeconomic indicators, by interest rates and earnings trends. So there's a gap that has developed. That's something of a risk to us because this model has not had that gap in so long. It's been very, very bullish on valuations, saying that you should pretty consistently be willing to pay or pay more for stocks than what the market is paying. So it's a little bit of a risk. Now, the nature of the risk, though, I think is important because the light blue line shows you that the market cap weighted index is intensely overvalued. The market cap weighted index is at 27 times forward earnings, and the model is way south of that, as you mentioned, 4 turns south, closer to 23 times. But the equal weighted index is still below the fair value model. So this also tells you that a lot of this excess valuation is really concentrated again in the highest market cap stocks, not just the Mag-7, because this is more than a Mag-7 problem, but the biggest stocks in the index are commanding such a premium amount of valuation that it's much more than can be substantiated by macroeconomic fundamentals alone. So I think it, again, just tells you a little bit about the potential for rotation. Tells you where the biggest risks are. Earnings misses from some of the biggest stocks in the S&P 500 could be very difficult for the index to overcome if we're not getting earnings momentum improvement and growth out of some of the smaller stocks in 2026. And this is unique. This is very unique relative to the last several years where we really haven't seen that distortion We saw it a tiny bit for the market cap weighted index relative to the model in 2024. It was something that was resolved in early 2025 with all the corrective processes that occurred in early 2025, but it's back again, and it's back again in bigger form than it was in 2024. So it's definitely a risk to stocks to consider for the year ahead.
Yeah, challenging. Yeah, definitely. And you look closely at the relative multiples, right? So
Yeah.
you noted that tech, media, and telecom (TMT) stocks are trading at the new post tech bubble high PEs, while the rest of the S&P is near 5-year average. So
Yep.
do you see the great rotations coming for 2026 as TMT growth potentially slows? What are the other sectors that you are looking for?
Yeah, I think that's a great question, and we should. You know, in theory, sorry, I unmuted myself. But to answer your question, which I think is a really astute question, we should see rotation out of some of these hyper expensive, extra concentrated areas of the market where earnings growth has been extraordinarily strong toward some of the undervalued segments of the market where earnings growth presumably should be about to pick up. That is what is implied in consensus earnings expectations. It's what's supported by the macro model. I would suggest it's also supported by broader sentiment, where sentiment toward the Mag-7, it does appear that the vast majority of people believe they should just own the Mag-7 and nothing else. It does appear that folks are concentrated in these segments of the market while ignoring the rest. I'll say I have to acknowledge it could go either way, though. Right? We need to watch it as we're seeing in the fall. We have seen some rotation into these underloved areas of the market, but we need a few things to go right for that to continue. We need to see the Fed continue easing policy. That seems likely at least into January, but will it continue beyond that is a big question mark for the market. We need to see this fiscal infusion of capital actually start to benefit non-tech segments of the market. We probably need to continue to see non-domestic markets perform reasonably well, because I think that's part of the story as well, is we need this rotation to broaden and risk appetite needs to stay steady. So the thing that I worry about most is if we get a big miss from the Mag-7, if people start to unwind the AI trade, if we lose a lot of confidence in the idea that these companies can earn fairly strongly into the future, that could be a bigger risk-off event that impacts everybody, regardless of how steady fundamentals are for the rest of the index. So you kind of need the Mag-7 to hold up their end of the bargain, at least steady growth without major misses. And that's been a question mark, admittedly, in the October quarter. Meta did not produce very good earnings.
Yep.
Right? And that's usually a harbinger of risk for the market at large. The market absorbed it really well, but between Meta's earnings and then what we're seeing with Oracle and CDS spreads widen, some earnings risks emerging in that really pure play on data centers, I think there are some cracks in this AI story that we're going to have to overcome in order to sustain a reasonable amount of momentum into next year.
Yeah.
Gina, when you start your day at HB Wealth, what's your step-by-step process? You have mentioned that breadth and leadership identify turning points, but clients care about momentum and relative strength. How do you prioritize these indicators when they contradict each other?
I go with the bulk of the story. So sometimes you do have contradicting indicators, and if there are enough contradicting indicators, they just neutralize each other out, and you have a neutral stance. Is basically the way that I look at it. When you have, I follow 17 different indicators for what I call market health. They give me a pretty good sense, I think, of at least whether or not the market is supported or not supported. by a combination of fundamental, macro, and technical indicators. And when more and more of these indicators are getting bearish, I generally get more and more cautious. When more and more of the indicators are getting more positive, I get more optimistic. And then at turning points, when everything's positive, I start getting really panicky. Okay, because it can't get much better. And when everything's really negative, we start getting really optimistic because it can't get much worse. That's the way that the system works. That means that I spend a lot of my life looking at these indicators. I look at all of them. And I try at least monthly to go through and update all of them and reassess the landscape for investing. At the same time, I look for new, right? So different things that have hit my radar screen recently. Really interesting things happening in the commodity space this year. What's going on with gold and silver and metals prices, and what might that mean for markets? Because frankly, commodities had just dropped off my radar screen for many, many years because they just weren't that relevant for equity markets. So that's something that I'm exploring into 2026. What might these things mean? Crypto. Crypto is another area that really hasn't historically been a part of my toolkit, but something shifted materially with the pandemic. Prior to the pandemic, crypto and the NASDAQ tech stocks at large were negatively correlated. They were offsetting each other. Since the pandemic, they've been incredibly positively correlated. So that triggered a risk signal for me in October. I noted it. It's not necessarily part of my checklist, but I'm going to think about maybe considering crypto as a broader signal of market tolerance. When crypto works, it really works well for tech. And when crypto is not working, tech tends to be a little wobbly, if not outright in decline. Is that the new normal, or is that changing? That's something that I'm going to consider. So it's a combination, really, to answer your question in a very long-winded answer. It's a combination of relying on that historical toolkit for the framework, and then being, I hope to be as open as I can to discovering new signals that might be emerging in the equity markets. You know, certainly 10 years ago, we weren't talking about Mag-7 specifically. Remember FANG, and then FANG Plus, and now Mag-7? We thought FANG was such a big issue. There was no concentration risk issue at that point. Nobody talked about Hirschman-Herfindahl in 2015. I can almost guarantee it. Just wasn't an issue except for in emerging markets. So I think, you have to be as nimble as possible to recognizing that markets do change. They teach us lessons every day. We should learn from those lessons and assess their meaning for the future.
Gina, it's time for the question we ask every guest.
Okay.
You have made some incredible calls in your career, but we learn most from pain. What was your best call where the MVVP model and the macro align perfectly? And conversely, what was your worst call, the one where the market humbled you, and what did you learn from it?
Well, good thing you started with best, because then I can at least start on a high note. Best call was probably, I distinctly remember in the thick of the pandemic, being able to rely on our sentiment work, as well as the combination of massive federal fiscal and monetary support to get bullish. The same week that stocks bottomed, we were publishing and we were getting on conference calls and getting excited and getting more bullish on stocks in that 2020 low. We confirmed that the sentiment model worked really well in late 2022. So those two bottoms worked really, really well for stocks. Most recently, the one that I missed and kind of had to catch up on was the bottom in April. I mean, the extraordinary sort of uncertainty brought about by that trade policy conversation, if you will, was really difficult to capture in my modeling framework. It became a very headline-driven market that moved far too quickly for my models to catch it, because normally even the pandemic was enough weeks that we could catch a sentiment downdraft. that was pretty profound and also substantiated by fundamental downdraft in expectations to catch that low. It was too fast in April. And we had started to see stocks turning over in February and March, but the weakness wasn't profound enough. And then all of a sudden, the floor dropped out from under the equity market. And the trigger point for rotation wasn't a fiscal policy infusion or a monetary policy infusion. It was a trade policy reversal, which we have not seen before. So it was trade policy got us in, trade policy got us out on either end, but I don't have a model that can really capture that.
Yeah.
So that one was really tough.
Yeah, because I remember that day that Trump tweeted on Twitter, he said, "Oh, I think it's a great time to buy the market," something like this. I don't remember the sentence, but that was a signal. So it's completely unpredictable from
very different
from the model standpoint.
Yeah, I don't have a president's Twitter-based model approach, so I was, and then you also, I don't think we had any confidence as to which direction the future trade policy was going to go for quite some time. So it took until May for our economic model to signal that we had hit another economic momentum low. It took until June for us to really capture a lot of the sentiment data that shifted around that period. So our modeling was too slow to catch that low. I'm proud of how it caught the top. So going into 2025, it was, our models were telling us to get a little bit more cautious because we were sitting on extraordinary levels of positive sentiment by the end of 2024. If you remember, it was just the market, nothing could possibly go wrong. It was just, and that's a little bit scary. And so those are periods of time when you run a risk off a little bit in preparation for disappointments emerging. Those disappointments did start to emerge in January and February. And then we just had a washout in April, and we've been off to the races ever since. So definitely missed that one. And there are a lot of them. I struggle with sectors sometimes. Factors have been fascinating this cycle, as I mentioned. Momentum's the only factor that's been working. Thank goodness we're all technicians on this call, because it's the only thing that's actually worked as a factor for the last 3 years, which is crazy, very different than normal. Value and quality used to be negatively correlated. They've been trading together. That's completely bizarre. There have been a number of times in my life in which the energy sector has just given me gray hairs. That energy sector, I'm always chasing the oil price around and missing what's happening with the energy sector. So there are so many lessons to be learned on a daily basis from the markets.
Yeah. Is this something related to the quantitative funds, like passive funds versus active funds, like CTAs, and that have the high frequency trading things related to all these things that we are talking about?
Well, I think that in fits and starts. Yeah, I think, for instance, with the trade policy issues that emerged in the spring, by the time we got to April, we had enough systematic traders trading on Trump tweets that did create or did at least contribute to the volatility in the equity market.
Yeah.
Right. And I think there were triggers on trade tweets that were impacting stocks trading. I struggle to completely blame passive for this. I mean, the passive markets, investors have been becoming more indexed and more passive for years. It didn't magically kind of become a thing in the post-pandemic environment to exacerbate the Mag-7 trade. Mm-hmm. And if anything, what we've seen in the post-pandemic environment is rationally, money is concentrating in just a few names that are producing the greatest earnings growth. That's not a passive phenomenon so much. It seems much more an active choice. So I don't think it's necessarily passive. What I do think the impact of passive investment flows has been is a constant bid for US equities specifically that has built up over a period of years. In particular, because the US retirement industry is, we are a defined contribution rather than a defined benefit country. And those defined contribution plans are largely focused on equity investment. So as long as the general household in the United States is employed, they're sending every 2 weeks money into the US equity market. And more so the US than the rest, because if you look at any sort of allocation in the defined benefit, it's a lot harder to get non-domestic exposure in your US equity portfolio. You have to work for it. And so you're going to get US stocks as a component of your defined contribution plan. And so as long as we have employment, we have this constant bid for stocks that doesn't exist in a lot of other areas of the world. And that's a passive phenomenon because investors are, just methodically investing every 2 weeks into the US equity market. So I think in fits and starts, those ideas are having real impacts. Those industry developments are having real impacts. I think sometimes the rhetoric around them maybe not as quantitatively provable, but sometimes there are real issues that have developed and they are changing markets without a doubt in some way, shape, or form.
Yeah, definitely. And let's talk about your mission now at HB Wealth. So you're focused on bringing unwavering financial peace of mind to clients, of course. And how does your institutional data-heavy background help individual families sleep better at night? And is it about removing emotion with data?
Yeah. It is. A lot of it for me is about removing emotion with data. And also, though, helping the families that we serve understand that we're addressing it. We're dealing with it. We're on top of it. We know what's happening in the markets. We can help explain what's happening in the markets to you. And we have an investment strategy for dealing with whatever is going to come our way. That's really what I hope to bring to the table is we have all of these tools to analyze the markets. We're constantly going to be on top of this for you, so you don't have to be. And we're on it from a data-based, quantitative, model-based approach that is not emotional, minimizes as much human sort of emotional decision-making as possible, and maximizes historically proven, probability-based analysis that hopefully helps to improve the portfolio's performance, preserve and grow wealth over time, and give our clients the service that they expect from us.
Great. So if you could give one piece of advice to the next generation of technical analysts, as well as the CFAs, something they won't find in any textbook, what would it be? Bonus points if it fits on a sticky note above a terminal.
Oh my God, I should have thought about this before this call because I'm probably not going to get the sticky note. I have a tendency toward verbosity, so the sticky note qualification, I'll miss the bonus points on. But I think the most important thing in markets is to constantly learn from markets. Be a student of the markets themselves. Don't get caught in your own preconceived notions as to how things should work. Recognize how they are working. Recognize when things have changed and modify as they change. I think back to, some of the textbook training, which is all wonderful and sets you up with this great framework. But ultimately, the markets are going to outpace the textbooks. The textbooks are written as the markets develop. And you've got to refine and develop your own capability set and your own sort of analytical toolkit in order to progress with the markets and recognize when something's changing as quickly as possible. And I don't mean that in a in the way that, you know, every day you want to change your process. Develop your process, find ways to constantly improve that process over time, and let the market be your guide.
And the market be your guide. So, Rafi, last question.
Yeah, last question, Gina. Well, this has been a masterclass for us here. So where can our audience follow your work, learn from HB, and of course, your work?
Oh, that's so nice of you to ask. So you can find my work now on the HB Wealth website, hbwealth.com. It's under the Insights and News. My commentary is called Market Sense. So we're making sense of the markets on a daily, weekly, monthly, quarterly basis for you and publishing right to the website. You can also follow me or HB Wealth on LinkedIn or on X. We have, I post quite frequently, and my colleagues across HB post as well. So LinkedIn and X are good places to find our work. I'm Gina Martin Adams, and HB Wealth is the handle for my company.
Gina, this was incredible. You have a unique ability to make complex quantitative concepts like the HERFINDAHL-HIRSCHMAN INDEX sound not only important, but actionable. Thank you for sharing your models, your shots, and your time with us. Rafi, thank you again, man.
It was a pleasure to have you here, Gina, here with us. Always glad to get in touch with you, and I wish all the best to you at HB. And
thank you, and thank you both for having me. It really was a pleasure. And let the markets be your guide. That's my sticky note.
Yes.
That's all for today on Traders of the Old Age. Thank you again to Gina Martin Adams. Until next time, watch your multiples, respect the breath, and keep searching for that peace of mind. Take care, and let the market be your guide, as she said.